Now, the second part, strategy, balance scorecard, and profitability analysis. So now we are moving towards uh, these are learning objectives we already discussed in our first part. Evaluating strategy, like we have to see that if we make a change in our strategy, how we can measure that. That's what we call it as a profitability analysis. Now, strategic analysis of operating income, that's the financial perspective, how we evaluated that, what is uh, where we can identify that what is going to be the cause of this change in our financial perspective. Like we can divide this into three components. The first one is a growth component, that it is really a increase in our sales or number of units or services we are selling is increased. That's what we call it as a growth component. So measure the change in operating income attributable solely to the change in the quantity of the output sold between the current period and the prior period. So that's a one way of analyzing the profit, is one we have to emphasize on growth component. The second is price recovery component. Measure the change in operating income attributable solely to change in the price of inputs and outputs. Means if the price is changing, like you are selling a product and now the price is increased from 100 to 120, this 20 increase is not this increase in your revenue is not because of the efforts of the marketing department. It is not because of the efforts that we are producing or are satisfying our customers more. It is only because of the price increase. So if we increase our revenue by just increasing the price, that is uh, we have to see from a different perspective as compared to see as the growth of the organization. Sometimes also it happens that the net income or operating income goes down, although our revenue is going to increase. And this can be also because of the increase in input prices, because input prices are also like increase in wages, like increase in the raw material, like increase in the gas prices. So these are the things that we have to keep it mind when we are analyzing the price recovery component. Not only the input prices, but output prices, both we are considering. And the third way is that the strategic analysis of operating income, and that's what we call it as a productivity component. So, we are emphasizing on balance scorecard or in the first part of the chapter, like learning and growth and improvement in our internal processes. So these two components. So these two components is really playing an important role if we increase our productivity, like after training of the employees or after more satisfaction of the employees. Are they more productive or not? So this component of analysis is going to give us the idea that is really we improve our productivity or it's only because of the increase in the price component. So you see, these are the three components of analysis for profitability. The reason behind, again, the balance scorecard, four areas of concerns or four areas of perspectives, like financial definitely is not going to cover under the growth. The customer satisfaction is also going to cover under the price recovery component and the growth component, and the rest of the two are covered under the productivity component analysis. So this is going to be like this. Now, how we can measure this? These are the formulas that we can use to calculate. So the growth component, how we calculate revenue effect of growth. This is the revenue, and then we also see the cost effect of the growth. So these are the two things we calculated. So revenue effect of a growth is actual units of output sold in a current period minus actual units of output sold in the prior period. So that's a growth component. Revenue effect of a growth. Actual units of output sold in the current period minus actual units of output sold in the prior period. Now, cost effects of a growth for a variable cost. This is cost effect of a growth for a variable cost is units of input required to produce current output in the prior period minus actual units of input used to produce prior period output. So that's the change that is going to give us the cost, variable cost. And then similarly, we also see the cost effects of a growth for fixed cost. cost effects of a growth for a variable cost effects of a growth for a fixed cost, and then the cost effects of a growth for uh, if we have an adequate capacity, like already we have a capacity, we can produce more, so fixed cost is not going to change too much. But if we have a assuming inadequate capacity and we want to change the capacity, so definitely the fixed cost is going to change. So this way that we can calculate the growth components. Then how we calculate the price recovery components. Again, the revenue effect of a price component, selling price in current period minus selling price in the prior period into the actual units of output sold in the current period. So this is the revenue effect of growth. Then cost effect of recovery price for variable cost. And then we have a recovery price for fixed cost. And we again assuming two things. One is adequate capacity and the other one is inadequate capacity. Uh, the last one is a productivity component. The productivity component is saying cost effects of a productivity for variable cost. That's cost effect of productivity for variable cost. Uh, Now, why we are because productivity is not going to affect the growth, but we are seeing here that so actual units of input used to produce current period output minus units of input required to produce current period output in prior period into input prices current period. So this way that we can calculate cost effect productivity for variable cost and then cost effects of productivity for fixed cost assuming adequate capacity and cost effect of productivity for fixed cost assuming inadequate capacity. Now, this is an example that you can see from your book as well. So this is an income statement from year 2018, and this is an income statement for year income in 2019. So we want to see the strategy impact over this 1 year period. And we see that the income is increased by 2 million, 2.2, 2.525 million favorable. If it is increase in income, it is favorable. Now, this favorable change of net income, change in net income, this is a financial perspective. We see that there is a positive change. Now, this positive change in income can attribute to different aspects. The first thing what we see is a revenue and cost effect of a growth component in 2019. So the revenue and cost effect all together. So the first one is a revenue effect and the second one is a cost effect. So we see here the favorable revenue effect and unfavorable cost effect. So the net effect is favorable from the growth perspective. Then price recovery component is unfavorable for both the revenue and the cost, and the overall it is unfavorable with 2.907 million 500. The productivity growth, there is no revenue factor, but there's a this is a favorable component, and when we add up this favorable with the revenue growth favorable and the price recovery component unfavorable, so ultimately we get the result which is again equal to the change. So this is the way that it works. We have to figure it out the growth component, we have to figure it out the price recovery component, and we have to figure it out the productivity component. And when we add up all these favorables and unfavorables, we get it the net change, which is because of the change in our financial statements or financial position. There is also a possibility that we can do a partial productivity and a total factor productivity. So compare the quantity of output produced with the quantity of input used. So the quantity of output produced, partial productivity, and quantity of input used. And if we want to find out the total factor productivity, the result of changing all inputs simultaneously, so the quantity of output produced minus the cost of all inputs used. The management of a capacity, that is also important because we just discussed that the fixed cost with the adequate capacity and with the inadequate capacity. So managers can reduce capacity-based fixed cost by measuring and managing unused capacity. And unused capacity is the amount of productive capacity available over and above the productive capacity employed to meet customers' demand in the current period. Now, how we can analyze of unused capacity? Two important features: engineered cost, result from cause and effect relationship between the cost driver and the resources used to produce that output. And discretionary cost have two, again, components. They arise from a periodic annual decision regarding the maximum amount to be incurred, and they have a no measurable cost and effect relationship between output and resources used. Managing unused capacity, how we can manage unused capacity? One way is that downsizing or right sizing is an integrated approach of configuring process, product, and people to match cost to the activities that need to be performed to operate effectively and efficiently in the present and future. And we see many times many organizations are laying off people, and the reason behind it is that we want to downsize or we want to right size our organization by laying off many people. So use excess capacity to increase production and revenue. So these are that we can either we can downsize or we can increase our output so that we can utilize our capacity. So this is all from the theoretical or some discussion point of view. Now I'm going to do one question in order to solve it to see that how we can uh, deal with that. Okay, let's start.
Well, so I want to solve this question in order to get the good idea about what we discuss in this chapter. So let's start. Gray Corporation makes a special purpose D4H machine used in textile industry. Gray has designed the D4H machine for 2018 to be distinct from its competitors. So it's a differentiated product. It has been gradually regarded as a superior machine. Gray presents the following data for the year 2018 as well as 2019. So we see here units of D4H produced and sold, selling price, direct material in kilograms, and direct material cost per kilogram. That's the price for per kilogram direct material. Manufacturing capacity, units of D4H, 250 for each year. Total conversion cost, 2 million for 2018 and 2.025 million for 2019. Conversion cost per unit of capacity, 8,000, and for 2019 it is 8,100. So selling and customer services capacity, 100 customers in 2018 and 95 customers in 2019. Total selling and customer service cost 1 million, and in 2019 it is 940,500. Selling and customer services capacity cost per customer 10,000, and then in 2019 it is 9,900. Design staff 12 each year. Total design cost 1.2 million and 1.212 million in 2019. So design cost per employee is this. What is important to read here? Gray produces no defective machines, but it wants to reduce direct material usage for per D4H machine in 2019. Manufacturing conversion cost in each year depends on production capacity defined in terms of D4H units that can be produced, not the actual unit of D4H produced. Selling and customer service cost depends on the number of customers that Gray can support, not the actual number of customers Gray serves. Gray has 75 customers in 2018 and 80 customers in 2019. At the start of each year, management uses its discretion to determine the number of design staffs for the year. The design staffs and the costs have no direct relationship with the quantity of D4H produced or the number of customers to whom D4H is sold. Now, there are three requirements that we need to calculate. The first one is calculate the change in operating income of Gray Corporation in 2018 and 2019. Calculate the growth, the price recovery, and productivity components of change in operating income between 2018 and 2019. Then we have to comment on your on our answer in requirement B. What do these components indicates? So let's start with the part one, or we can say it is no, I have to draw and with the black pen. So let's start. So the first thing what we want to calculate is operating income for each year. And we have a 2 years, 2018 and 2019. Revenue, we all know that revenue, and revenue is 40,000 per unit into 200 for 2018 and 42,000 into 210 for 2019, and by this way we are getting $8 million revenue for 2018 and 8 million and 820,000 for 2019. That's our revenue. Then we have to look at the costs, and direct material cost, we know that they applied $8 per kilogram into 300,000 kilograms, and for 2019 we applied 8.50 into 310,000, and by this way we get it 2400, and this one we get it this. Then we have a manufacturing. Manufacturing conversion cost, conversion cost is the labor plus manufacturing overhead. So it's 8,000 into 100 and 9,900 into 95. So we see here it is 2 million. Oh, sorry, it's a 250. And it is also 250. So we see 2 million here conversion costs, and it is 2025,000. Selling and customer services. So we see here 10,000 into 100 and 9,900 into 95. So we get it here 1 million in 2019 and 940,500 in 2019. Design cost, design costs. So we see it is $100,000 into 100 and into 12 and 101,000 into 12. So we see here it's a 1.2 million and it's a 1.212 million. And the total cost, if we add up, is as a total cost. Total cost is 6,600,000 and 6,812,000. And if we subtract this, so we get it operating income. Operating income, which is 1 4 and the difference between these two, we call it as a favorable because it's increasing, and that's a 607,500 favorable, right? That's a change in operating income. Change in operating income. So this is the first part. We want to calculate change in operating income, and we see $607,500 favorable. Now the second part is saying calculate the growth, price recovery, and productivity component of change in operating income. So we have to break it down, this change in operating income, into three breakups. One is that how much is contributed this positive change of operating income towards the growth, towards the price recovery, and towards the productivity. So let's start and move on to the next page. I'm trying to go to the next page. Okay. So this is a second point, and we are calculating the growth component. The growth component. Now growth component, the first thing what we have to calculate it is a revenue effect of growth. Which is, we can say that actual units of output sold in 2019, which is 210, minus actual units sold in 2018, which is 200, multiply by the price of the 2018. So we get it that is 40,000. So we get it like 400,000 favorable. That's a revenue effect of a growth. Revenue effect of a growth. Now the cost effect of a growth for variable cost and cost effect of a growth for a fixed cost, we have to calculate it. Now, but we have to keep it in mind that we need to find out that units required to produce 2019 output in 2018. How much units we required to produce 2019 with the same proportion what we used in 2018. So if we want to calculate it, so it's going to be, so that's a revenue. So that's a revenue effect of growth. And so we have to calculate it in a way that 300,000 divided by 200 into 210, so we get it like 315. That is what we call it as a units required to produce required to produce 2019 output in 2018. So we have to make the same proportion. Also by this way we get this as a unit in number of units. Now what we can do is we see the cost effect of growth component. The cost effect of growth. So we calculate just the revenue effects. Now we want to calculate the cost effect. So direct material, again, now in this case, now it is a difference between 315,000 minus 300,000 multiply by 8, so we get it 120,000 unfavorable, because the manufacturing conversion cost is 0, because 250 minus 250 is 0, so multiply by 8,000 is going to be 0. Similarly, selling and customer service cost is also 0, no change. And design cost is also 0 change. So there is 120 unfavorable, this. And we know the revenue growth effect of revenue, $400,000 favorable, and cost effect of growth is 120,000 unfavorable, right? So it's going to be 280, sorry, 28000 favorable. That's a growth component. What is it? It's a change in operating income due to growth. Change in operating income due to growth. We already taking care of the revenue and the cost. So this way we see that's a two the total change is 607,500, and out of which 280 is because of growth component. Okay, now we move on to the price recovery component. So the revenue effect due to price recovery is selling price, which is selling price in 2019, which is 42,000 minus 40,000, 42,000 minus 40,000 into 210. So we get it like 420,000 favorable. Now we have to see the cost. Cost effect of price recovery, and we see all the effects in this way, like direct material, and we see 850 minus $8 into 315. That's a so we get it 157,500 unfavorable. Manufacturing conversion cost, so we see here 8,100 minus minus 8,000 into 250, so we see 25,000 unfavorable. Selling and customer service, so it's a 9,900 minus 10,000 into 100, so we see here 10,000 favorable. Design cost, design costs, so it's 1 into 12, so it's going to be 12,000 unfavorable. And by this way we get it 184,000 unfavorable. So the overall like just we calculated for growth, we have to see revenue price recovery, which is $420. Cost effect of price, this is favorable, and recovery, cost effect of price recovery is $184,000 unfavorable, and by this the net change in operating income due to price recovery is $2 it's a 500, sorry, it's a 500 because it's a 500. So 500, so we get it 235 500 favorable. So two elements are going to be favorable, this 280 and 235. So if you add up 280 and 235, so 4 and 5, 515, 500. So we so far what we discussed is 515, 400 is explained by the way we discuss, and the remaining around 93,000 is going to explain through the component, we call it as a productivity component. So the third one is the productivity component. And the productivity component we see direct. Now productivity component is not going to explain the revenue effects, but we're going to talk about the cost effects. So direct material, and we see here direct material is 300 310 minus 315, because we, according to the proportion in 2018, we need to use 215, but we used only 210. It means it's a productivity beneficial, and we apply the rate, so we get it like 42,500 favorable. Manufacturing conversion cost has no effect, so manufacturing conversion cost conversion cost is 0, and selling and customer service is 95 minus 100 into 9,900, so that is going to be 49,500 favorable. Design cost also have a no change or no increase in productivity, so we write it 0 here. So altogether we see here is a 92,000 favorable. Now we can do analysis like if we add up, so we can see here if I use a different pen color. So the first thing is that's our change in income. That's on one side. If we write it 607,500, that's a favorable change. And now we get three components, and the first component is the growth component, and that is 280, 500 or 280, just 280, yes, 280,000, and that's also going to be favorable. So add 235,500, and that's a price recovery 235 or 35 or 30, yeah, 35,500, and that's also favorable, plus the productivity component, which is 92,000 favorable. So if you add, you get this one is also 607,500. So we can see that we effectively explain the change in operating income because of these three different components. Now the third part, the important point to note for the third part is value leadership. The value leadership is increased value leadership. Why? Because they add up value to the customer, and we see the biggest change is in change in operating income, due to growth, change in operating income due to growth, which is 280. So we can say that they are using a value leadership strategy. The company was able to continue to change a premium price while growing sales. So Gray was also able to earn additional operating income by improving its productivity. Improvement in productivity. Although the price recovery is also there, but we see these two important factors. So this is all I want to share with you regarding this question. It's a comprehensive question to give a full idea of the chapter, and I hope you like it. So see you